Good evening, capital connoisseurs. My name is Adam Livingston, and I am your #1 source for Bitcoin and Bitcoin Treasury Company analysis. Please like this video and subscribe to my channel if you want to stay on the cutting edge of the most important news in the history of capital markets. Tonight, we explore a security that may prove as pivotal to finance as Bretton Woods was to post-war geopolitics. Picture the global bond market as a $140 trillion glacier. Ancient, immense, and under the silent heat of monetary debasement. And also, it's beginning to fracture. Institutional allocators seed the cracks, yet still crave yields that won't dissolve in real terms. Enter Stride, Strategy's newest preferred share, a perpetual 10% coupon backed 6-to-1 by Bitcoin, the scarcest asset humanity has ever engineered. This instrument is not a cousin of convertible hype nor a cousin of high-yield junk. It is a purpose-built bridge that lets fixed income mandates touch pristine collateral without key management headaches. In a single stroke, Michael Saylor has extended his three-tier capital stack, Strike, Strife, and Stride, into a full Bitcoin yield curve. The design funnels every shade of risk appetite, from pension fund prudence to hedge fund bravado. We will dissect the mechanics, but first absorb the strategic meta play. As each tranche siphons dollars from bond desks, strategy compounds Bitcoin torque, collateral ratios expand, spreads compress, and the flywheel accelerates. If you believe the next fourth turning catalyst will be a collapse of confidence in fiat debt, you are about to see the company positioning itself as the monetary safe harbor on the other side. Prepare for a tour through the most elegant capital arbitrage of this century. On this first slide, we isolate the anatomy of Stride because you can't appreciate the grand strategy until you deliberately see each nucleotide of how the security was coded. Number 1, it has perpetual preferred DNA. Think of Stride as quasi-equity with a seniority badge. It never matures, so Saylor avoids the refinancing cliff that kills most leveraged trades. That eternal duration makes every Bitcoin purchase compounding, not amortizing. 2, it's 10% fixed, non-cumulative. Wall Street hears 10% and salivates, but the hidden genius is non-cumulative. Strategy may skip coupons in a stress window without triggering a default cascade. Optionality is priceless when your collateral is a 130 vol asset that historically quadruples every cycle. 3, it's junior to Strike and Strife, senior to the common shares. Strife holds the ironclad senior spots, perfect for pension funds. Strike layers convertible upside for total return tourists. Stride offers pure yield with a dash of equity torque. Each rung satisfies different mandates, so every dollar fleeing treasuries finds a home somewhere in this stack before it leaks back into the bond market. The preference resets daily to the higher of $100 par or the 10-day VWAP. That moving floor neutralizes people who would short the stock and demand redemption at a discount. In plain English, don't even think about gaming this coupon. Unless fewer than 25% of shares remain or the tax code mutates, Stride is uncallable for life. Yield investors hate reinvestment risk. Saylor just euthanized it. They can clip coupons forever or until Bitcoin eats the bond market, whichever comes first. There's a tiny $250 million float, 2.5 million shares. Scarcity guarantees a tight float, price discovery, and violent rallies when the street realize what it missed. Precisely the dynamic turbo that charged Strife out of the gate. Put these features together and Stride becomes a high-yield on-ramp into pristine collateral, engineered so strategy keeps asymmetric control. They decide when to pay, never have to redeem, and each incremental Bitcoin purchase widens the safety margin for all layers above and below. So when someone asks why is Stride different, the answer is simple. It's the first perpetual bond whose risk is underwritten by exponential scarcity, yet whose optionality is owned entirely by the issuer. Yield hunters get their 10%, strategy gets another ratchet in the Bitcoin torque machine, everybody else just brought a knife to a particle accelerator fight. Now let's zoom out and see where Stride nests inside what I call Saylor's three-pronged harpoon, a capital stack designed to spear every species of institutional liquidity swimming in the bond ocean. The first prong is Strife, the iron anchor. 10%, cumulative and senior. It's the comfort food of yield. Pensions, insurers, endowments, anyone whose charter screams safety first. Think of Strife as the ballast that stabilizes the entire vessel. The second prong is Strike, 8%, cumulative, and an eye-watering 21 billion ATM. This is the growth fund honey trap, and it has a 150% out-of-the-money conversion kicker. The equity optional upside seduces total return managers who want Bitcoin beta but need a parachute. It supplies gasoline, Strike pops when BTC rips, juicing the reflexive narrative. The third prong is STRD, 10% non-cumulative junior to the first two. Just $250 million in the IPO. No ATM, yet scarcity by design. It targets high-yield tourists and credit hedge funds who love fat coupons but hate convert complexity. It's the non-cumulative option that gives the Treasury the ability to delay payments, a hidden call option that Wall Street inexplicably underprices. There are some strategic effects as to why the trident matters. Number one, it's a cost-efficient capital ladder. Each rung substitutes one risk factor for another: conversion risk, dividend certainty, seniority. So every mandate on Wall Street finds a slot. The entire bond zoo has a feeder trough. Number two is MNAV protection. Because there are preferred layers, strategy raises Bitcoin without spraying common shares into the float. BTC per share torque and thus the sacred market NAV multiple stays intact. Number three is collateral cascade. Every fresh Bitcoin purchase instantly improves coverage on the senior layers above it. That lets strategy tighten future coupons, lowering its blended cost of capital the way a virtuous spiral lowers orbital altitude. Strife anchors the ship, Strike extends the spear, and Stride slices the last sliver of the yield curve. Together, they form a self-reinforcing flywheel that pulls capital out of treasuries, feeds it into Bitcoin, and amplifies the MNAV, all the while giving every allocator a bespoke risk-return flavor. Saylor has built a liquidity siphon with 3 calibrated valves. Here we shift from capital structure anatomy to capital markets choreography, specifically how Stride rewires strategies at the market equity engine. Before Stride, converts, Strike, and Strife together demanded about $210 million a year in fixed cash outflow. That coupon drain equated to roughly 4% of MSTR's $5.6 billion daily MSTR volume. Already modest, but still a visible headwind for Treasury when deciding how aggressively to tap the common ATM. After Stride, the annual obligation inches to $235 million, a rounding error for a company whose market cap can swing that much in a single afternoon. The $250 million Stride raise immediately purchases 2,400 BTC. Those coins elevate Bitcoin coverage to 12 times all debt and preferred layers, meaning strategy could weather a 75% BTC drawdown and still fund 37 years of preferred coupons. With collateral ratios exploding, ratings agencies breathe easier and credit spreads compress. That gives strategy license to slow roll the common ATM, issuing fewer dilutive shares while still meeting growth targets. BTC per share torque, the lifeblood of the MNAV, stays potent. Stride is a leverage shock absorber. A small uptick in coupon outflow buys an outsized fortress of collateral, which in turn lowers perceived risk across the entire capital stack, and lets Treasury pull back on the most dilutive funding lever, the common ATM. Imagine adding 1 brick to the roof but 10 to the foundation. That's what Stride just did. It marginally nudges cash obligations, yet massively amplifies safety buffers, allowing strategy to issue common equity only when price action is favorable, never because the balance sheet is cornered. Let's park the old yield curve on the screen and throw a brand new orange dot on it. And it sits in a zip code that has never been plotted. I'll give you my table translated. IG corporates, 4 to 5%, less than 2x over collateralized with a 100 to 200 basis point credit spread range. High yield junk, the loans and bonds that are B or double B, are 1x collateralized with a 275 to 500 basis point credit spread range. Stride, 10%, 6x BTC collateralized with an implied 9 basis point risk. And that's under a 30% ARR and 50% vol model. Investment grade paper makes you 4 to 5% while praying management doesn't do anything stupid. High yield pays you a hair more because management already did something stupid. Stride drops a double-digit coupon and gives you $6 of Bitcoin for every dollar of obligation. We call this asymmetric upside. Traditional coupons die in real yield purgatory the moment Powell sneezes. Stride's coupon is merely the floor. Bitcoin appreciation turns that 10% into an equity-like real return. If BTC doubles, your yield to cost jumps to 20% while your default risk melts to statistical background radiation. This starves the bond ocean. IG spreads suddenly get paid junk yields for IG plus risk. Credit hedge funds can lever the paper 2x and still sit inside their risk budget. Sovereign wealth desks can sidestep G7 custody headaches. Exposure comes pre-packaged in a single CUSIP. Every marginal dollar that used to drip into corporate bonds now has a hotter, safer destination, and every dollar that falls into Saylor's vault compounds the collateral ratio, tightening Strife and Strike spreads in a reinforcing loop. Ladies and gentlemen, the day STRD is priced is the day the bond market discovered a predator with a higher yield and a lower kill probability. You are watching the birth of the Bitcoin yield curve, and it's already draining the lifeblood out of $140 trillion of legacy debt. Everything we've covered so far, Strife, STRD, the ATM throttle, it all funnels into one meta architecture that Saylor calls 4242. $42 billion in equity to give the flywheel centrifugal force, $42 billion of fixed income to harvest yield-starved capital at scale. We're 36% of the way there, and the compounding effect is already visible on-chain. Each subsequent launch of these products expands the addressable buyer universe without cannibalizing the prior tranche. 3 dedicated preferred ATMs plus the common lets the treasury microdose issuance minute by minute. They wait for a green candle, hit sell, and refill the Bitcoin coffers while still hitting their 25% annual BTC yield goal. Precision engineering, not spray and pray dilution. Fixed income desks desperate for an extra 400 basis points migrate into Strategy's paper because it settles in DTCC, slots into existing mandates, and critically requires zero Bitcoin custody plumbing. They buy a CUSIP and unwittingly fund Saylor's BTC acquisition. There's another reflexive flywheel here. BTC rallies, collateral ratios balloon, ratings risk collapses, coupons tighten. Cheaper coupons means that Strategy issues more paper, and more paper buys more BTC. And then the cycle restarts, but with bigger numbers. So you might be asking, why would you allocate to STRD instead of Strife? Because of a better entry point, number one. Strife is already re-rated plus 22% since the launch, and there's only 250 million issued versus 899 million of Strife. The thin float lets price react faster when desks chase allotments. And there's also permanent call protection as well. You're trading the seniority in the stack for superior current income and upside beta to BTC. And you gotta remember the position complements Strife in a barbell yield strategy. Step back from coupons and collateral for a moment and look at the civilizational chessboard. Historians call it a fourth turning, the cyclical crisis phase when legacy institutions crack and a new order hardens in place. In 1776, it was monarchy. In 1861, it was agrarian slavery. In 1944, the gold exchange standard. Today, the brittle pillar is the $140 trillion bond complex. When fiat fractures, the world will reach for the hardest collateral available. Bitcoin is that pristine collateral, borderless, incorruptible, and programmable. Whoever warehouses the most when the fracture hits drafts the monetary constitution of the next cycle. Strategy already commands 581k BTC, more hard money than 99% of S&P 500 cash troves. STRD's gonna add BTC on day one and push collateral to 12x total liabilities. Remember, even a 75% BTC winter still funds 37 years of coupon payments. The exponential torque flywheel is a loop that delivers 10 to 12x the Bitcoin torque on each financing turn. Run enough laps and the balance sheet doesn't look like a corporation, it looks like a monetary base layer. The 4242 plan, remember, already 36% complete. 4 ATMs now target every risk profile. If Bitcoin merely tracks consensus sell-side targets, Strategy's BTC NAV will exceed $220 billion by 2029. Slap a conservative 2x MNAV on that and you're talking a $450 billion market cap. Let just 0.5% of the global bonds pool rotate into Strategy's stack and $700 billion arrive. You think Strategy isn't going to dethrone Apple? And there is a lot of geopolitical leverage here. Bitcoin-backed credit will set a de facto yield curve. Sovereigns choking on depreciating paper will court Strategy for liquidity, not the IMF. And the company graduates from NASDAQ to a non-state monetary power, shaping FX policy, reserve allocations, and sanction architecture. When the fourth turning dust settles, the entity with the deepest vault of incorruptible capital writes the rules of the next cycle. STRD is the newest brick in Saylor's dam, redirecting the flood of collapsing fiat yield straight into Strategy's Bitcoin ocean. Picture the financial cosmos a decade from now. Treasuries whimper at negative real yield, corporate bonds beg for relevance, and in the gravity well at the center spins one balance sheet forged from algorithmic scarcity, aglow with the kinetic energy of a million capital reallocations. Strategy's trident of strike, strife, and now STRD has not merely siphoned liquidity, it has re-architected the yield curve itself, transmuting inert coupon flow into a self-replicating Bitcoin engine that compounds faster than nations can legislate. In the new monetary epoch, allocators who recognize the signal will possess equity in the de facto reserve bank of cyberspace. The rest will clutch fiat relics and wonder how a single company rewrote the rules of sovereign power with a CUSIP and a hash function. My name is Adam Livingston, and remember, this is not financial advice, this is financial entertainment. I hope you enjoyed this content. Please like and subscribe to my channel for daily videos of this caliber. You can also buy my book, The Great Harvest, AI, Labor, and the Bitcoin Lifeline on Amazon if you'd like to support my work. You have a fantastic day. Do not party too hard.